Yeah, thanks everyone. Good morning, and thank you for giving me the opportunity to talk about retirement income. That really is our focus at the American College. With this presentation this morning, I really want to focus on providing an overview of retirement risk and the two different approaches we have towards building retirement income strategies. There's this investment-based, probability-based approach on the one hand, and then there's a safety-first, insurance-based approach on the other hand. I do have some more sessions today at 4:15 and 5:15 where I'll be able to get into more details about all this, but this will be really an overview of it all. Now, that investment-based approach, I had a book on that, How Much Can I Spend in Retirement, that came out 2 years ago, and a brand new book on the insurance-based approach, Safety-First Retirement Planning, that will come out next week. So starting with the investments, everything begins with Harry Markowitz. In 1952, he published an article that gave us modern portfolio theory, the efficient frontier, the idea of building a diversified portfolio and using asset allocation to have an investment return. Now, he won a Nobel Prize for that in 1990, and then after winning the Nobel Prize, he was asked to write an article, how does modern portfolio theory apply to household investors? Now, his answer is really surprising, given that this is the foundation of everything we're taught. He said he never thought about it before. And after reflecting on it for an evening, he recognized modern portfolio theory was never meant to apply to households. He had developed it for large institutions like mutual fund companies. And there's a lot of differences, but to really highlight on the discussion today, households in retirement face an asset liability matching problem. They have to fund expenses over an unknown length of time. Modern portfolio theory is much more simple. It's an assets-only model. There's no need to take an expenditure. It's just how do you grow the assets over one period of time. And of course, there's some logic that if you can grow your wealth faster, you should be able to spend more in retirement. But it's not at all a perfect relationship, that households face a lot of different risks. And so this is really the beginning of the idea that retirement income and post-retirement is going to be different, and we have to think about it differently. So here's 7 reasons why retirement's different, and they all relate to the idea that retirees have less risk capacity, or that the lifestyle of retirees becomes more vulnerable to downturns in financial markets. So these 7 issues: reduced earnings capacity. So this is just the idea that once you leave the labor force, to the extent that it's hard to return to work, you lose that lever of flexibility to save a little more or work a little longer when there's a market downturn. Second, the visible spending constraint. And this is really what Harry Markowitz is talking about in terms of pre-retirement, we're often ignoring the need to take distributions. We're focused on growing those assets. But once we start to take distributions from our assets to fund our retirement spending goals, that has a significant implication. It leads to the third point. It's going to heighten and amplify the impact of investment volatility. The basic intuition here is retirements can still be long. We can be talking about a 30-plus year retirement, but it's going to be what happens in the first 5 to 10 years of retirement when you're taking distributions that's really going to lay the foundation of what kind of sustainable spending level you can enjoy in your retirement. Then as well, unknown longevity, not knowing how long the financial plan needs to last. Spending shocks. So on the one hand, we have our budget. How much do we anticipate spending each year? And then spending shocks are potentially high expense, low probability events that can happen later in life. Long-term care, major healthcare bills, and so forth, that require an approach, liquidity, having assets available to cover these unanticipated types of expenses. Compounding inflation. Even a low inflation rate like we've been experiencing in the US, that can build up over time when someone's enjoying a long retirement. And so if expenses are growing with retirement, that has to be part of the consideration. It's also another difference from modern portfolio theory, where the quote-unquote risk-free asset is a treasury bill that's not going to be able to keep pace with inflation. And then finally, declining cognitive abilities. Especially as people are aging in their 80s and 90s, it becomes increasingly difficult to manage an investment portfolio, to stay the course and not panic in the face of market volatility. And so it helps to have plans in place. Now, a friend of mine, Dirk Cotton, uses an analogy about this breakfast at his Retirement Cafe blog to define the retirement problem. And so what he says about this breakfast is, the chicken was involved in making that breakfast. The pig was committed to making that breakfast. Okay. So what he means by that is retirees need to think like pigs. that individuals pre-retirement, they're involved in the financial planning process. They're involved with their investment strategies and so forth. But post-retirement, they really become committed to their financial plan. They're going to get one sequence of market returns, one opportunity to have a successful retirement, and they need to make sure they have a plan in place that's more or less going to work for them no matter what's happening in the financial markets. And so that means building a strategy that can manage these retirement risks. Now, while we're on the topic of analogies, another popular one is mountain climbing. With mountain climbing, a lot more accidents and more of the danger comes when you climb down the mountain. But we might think about, well, what's the goal of mountain climbing? Is it to make it to the top? Well, that's certainly part of the goal, but you need to also make it back down safely. Now, in the investment world, there tends to be a focus on what's retirement planning about. It's about getting to the top of the mountain. It's about what's your number? How much wealth do you need to achieve to be able to successfully retire? But that's really only half of the problem. You have to make it back down the mountain safely. You have to fund expenses over an unknown length of time. And that can become more perilous. It's more dangerous climbing down the mountain than going up. So we have to manage these risks. They're the same risks as on the earlier slide. They're just arranged differently now. I put longevity risk on the top. This is not knowing how long the money needs to last in retirement. And there's two issues with it. The first is just the longer our retirement lasts, the more expensive it becomes because we have to keep covering each year's budget. So the cost of retirement grows with the length of retirement. And then as well as we enjoy a longer retirement, then there's more time for these other risks to become a problem. Macroeconomic related risks and market risks, inflation, but even a low inflation rate just compounding over time, and then those spending shocks, major healthcare bills, long-term care, helping adult family members in unexpected ways, those sorts of things. So when we think about these risks, with the investment approach, the logic that we have, it all goes back to something called the 4% rule of thumb. In 1994, Bill Bengen published an article that talked about, based on US historical data, how much could you spend and sustain that over your retirement? And he approached managing longevity risk and market risk in a direct way that I'll talk about. With longevity risk, the idea with an investment-based strategy is we plan to live a long time. We plan to live well beyond our life expectancy. He talked about, for a 65-year-old couple, plan to age 95. And then you shouldn't have to worry about living longer than that. So you have to spend less, stretch your money out to age 95, and you should be okay. The problem, though, is longevity is continuing to improve, and especially for the types of individuals that have a long-term focus and so who are thinking about investing in things, they may live longer than the average Americans. And so we get into this issue of, well, how long do we plan for? 95 may not necessarily be so conservative anymore. For a 65-year-old woman today, there's an 11% chance she'll make it to age 100. And for couples with two individuals, their joint longevity, they're going to live longer than one individual by themselves. So how do we manage these types of risks? Well, the investment approach is spend less, stretch the money out. And it's a similar story with the market risk. Bill Bengen's 4% rule article from 25 years ago was talking about how you can't use averages. He looked at US historical data, and he looked at all these different 30-year periods. What if you got the market returns from 1926 to 1955, 1927 to 1956, and so on? How much could you have spent? Well, if you used what would have worked historically to stretch that money out for 30 years, that's that nice cyan-colored curve going down to zero at the end of year 30. The average outcome, you spend your wealth down to zero. That average withdrawal rate in retirement that would have worked for a 50-50 portfolio is a 6.3% withdrawal rate. But we don't experience the average. There's volatility. And all these purple lines are just how would your wealth evolve if you're using an average strategy over the different 30-year periods. Half the time you have money left after 30 years. Half the time you run out before 30 years. And in the worst case, you're running out in about 14 years. So now this is speaking to what's the investment approach towards retirement income. To be conservative, he wants the money to last for 30 years in that worst case scenario. So we can't rely on what worked on average. We have to lower the withdrawal rate. And then 4%, and what this means is, like, just to make the math simple, if I have $1 million, taking out $40,000 of what I have at retirement, gives me a baseline spending level that I can adjust with inflation and expect that money to last for 30 years. That became the answer to the question, how low does spending need to go to make sure you can stretch that money out? So related to this as well is this lifetime sequence of returns risk. What this chart is showing is for somebody who's going to be investing for 60 years. How important is the market return from each year to explaining their lifetime financial outcomes in terms of how much wealth will they have at retirement, how much can they spend sustainably throughout their retirement? Now, if I just put money in the market in year one and watched it grow for 60 years, all these bars would have the same height. There's no sequence risk. The order of returns doesn't matter. I'd always end up with the same amount at the end, no matter what the order of returns is. But here's an individual who's going to work and save 1% of their salary for the first 30 years, retire in year 31, and then take distributions from their assets and fund a retirement for the next 30 years. And what we can see is market returns early in people's careers don't really matter all that much. It's just because they haven't put much into their portfolios yet. But by year 30, that's the last year of their career, that's the most important pre-retirement return. It's impacting 30 years worth of contributions to their account. And then they retire in year 31, and they take 30 years worth of distributions. Now, that really fundamentally changes things, where the importance of those early retirement years, that's like the year 31 and later, it's really significantly important, disproportionately important. Those first 5 to 10 years of retirement are really what's going to drive the outcomes. And then you can see after about halfway through retirement, market returns don't really matter anymore. That 4% rule of thumb that Bill Bengen talked about really illustrates this point because it was based on the market returns from 1966 to 1995. In 1982, there's a big turning point. Markets do great after 1982, and that would be that second half of the retirement period. If I retired in 1982, I could have used almost a 10% withdrawal rate over the next 30 years. But for somebody retiring in 1966, they don't get to benefit from those great markets after 1982. They've spent down their portfolio too much by that point, and they're not getting the opportunity. Their retirement outcome, getting that worst case scenario in history, was driven by what happened early on. So retirement income planning revolves around how do we manage this longevity risk and then this amplified market risk that we experience from taking distributions. And so to start thinking more about that, here's basically a menu of spending options. If I knew the market return up on top and I know how long I'm going to live, I can figure out exactly how much I can spend. If I had $1 million, this is the spending levels. Now, of course, we don't know what the market return will be. We don't know how long we're going to live. But that column I've highlighted in purple is where we are today with bonds. If I want inflation-adjusted spending, in the US, since 1997, we've had TIPS, Treasury Inflation-Protected Securities. They provide a real return plus inflation adjustments. And right now, TIPS yields, even the 30-year yield is about 0.5% real, or 0.5% plus inflation. So even that column's a little optimistic because it's assuming any TIPS I want to buy is 0.5% real return. And that's the menu of spending options. Now, if I want to plan for a 30-year retirement, so 65 to 95, that would be about 3.58% withdrawal rate. $1 million could only generate about $35,800 of inflation-adjusted income. Now, if I want to spend more than that, bonds aren't going to work. And this is where I now have to look at the alternatives. I can use an investment-based strategy where I'm going to rely on the idea that the stock market will outperform the bond market and assume a higher rate of return and then spend at a higher level. And there's no good term for what this logic entails. I call it amortizing the upside. I'm going to assume I'll earn a higher rate of return from stocks, and I'm going to spend more today in the hope that I achieve those returns. And then if I do achieve those returns, I'll be fine. If I don't achieve those returns, I'll get myself into trouble. The other approach, though, is risk pooling and insurance. If you think about a simple income annuity as an example of this, you've got a risk pool. The premium goes into a bond-like portfolio, and then those who don't live as long help to subsidize those who live longer with contractually protected payments. That's another way to allow for a higher spending level than bonds can support. And so we get into this trade-off. Do I use risk pooling with insurance, or do I use the risk premium with the stock market? And I think in the investing world, there's this idea that it's very easy for the stock market to outperform so that you don't need risk pooling and insurance. But the reality is it's a lot more difficult to beat risk pooling to get these contractually protected payments from the risk pool that investments are unable to provide. And that's really the theme of that 515 presentation. I'll show a lot more numbers about that. But these are the options, though. Do I go with the risk premium from the stock market or risk pooling from insurance? I'm trying to fund these 4 L's, the financial goals of retirement. They're my lifestyle and longevity, which relate to my budget, liquidity, having expenses not earmarked for other purposes. And this is another important point. An investment portfolio is liquid. A brokerage account, you can tap into that money. But if you've earmarked it for something else, you can't really just use it freely like you might think. If I believe in that 4% rule and I have a $40,000 spending goal and I have $1 million in a brokerage account, though technically that $1 million is liquid, it's not really liquid. It's earmarked entirely to cover that spending goal. So by liquidity, we mean assets that are not earmarked for other purposes. And then legacy goals, having money to leave for the next generation as well. So this is how I view building a retirement income plan, where those 4 L's, the goals on the left, they map into the expenses associated with those goals on the right. And then we don't think about just investment assets to fund retirement expenses, but treating assets as reliable income, diversified investment portfolios, and reserve assets. And thinking about what's the best way to mix and match our household assets, not just the investment portfolio, but all of the assets, Social Security benefits, home equity, the option of considering insurance-based approaches as well, fitting that all together into an overall strategy. So to wrap that up, as I'm saying, there's these 2 different approaches that we have. Probability-based with investments on the left, safety first with insurance on the right. And they'll answer the same basic questions in completely different ways. So you really have to consider your style. Which sort of approach works best for you? Are you comfortable with the stock market and risk premium, or are you more comfortable having contractual protections? How do you prioritize amongst your goals? What sort of investment approach will you use? How do you measure retirement success? And are you comfortable basing future retirement success on what worked in US historical data? Or do you want something that might have a more applicable international experience, or just, that there's a maxim, what worked in the past doesn't necessarily work in the future. So how do you want to be thinking about that issue? So thank you very much for your attendance. And if we have a minute for questions, I'm happy to consider any. Thank you very much. Yes? So the question is, for a self-directed investor, is there a way to do better than, say, a 60-40, 50-50 type portfolio? Or should we be scared of the question? Well, so there are issues related to cognitive decline, and also considering if there's one member of the household who's more financially sophisticated, you have to think about an action plan for what's going to happen to the rest of the household if that person either loses their ability to manage the portfolio or otherwise dies. I mean, you've got to protect the family in that way. Beyond that, I think just a general, if you're comfortable with a passive investing type of approach, relying mostly on index funds, low-cost passive investments, that sort of approach can be fine. You do need to have the wherewithal to stay the course. But also it's worth considering how things like risk pooling and shifting some of the bonds into an insurance-based lifetime income protection can really lay the foundation for helping to manage those types of risks as well. Oh, and okay, time's up, so thank you very much.